What's up, YouTube? Welcome to another episode of Finance and Freedom. My name is Todd, and today we're going to talk about the Fed rate cuts tomorrow and what that means for you and what you should do to prepare. But before we get into it, so there is about a 95% chance that the Fed is going to cut rates tomorrow, which is pretty exciting stuff. We haven't seen a rate cut in a long time. As many of us know, mortgage rates have been expensive. Just any type of loans have been very expensive. And so kind of excited to see that. People haven't been refinancing their homes. People haven't been moving because homes just cost too much because of the interest rates. So here's what we can expect because of the Fed rate. According to CME FedWatch, markets are assigning about 94 to 96% probability that the Fed will cut the federal funds rate by 25 basis points. Now, for those of you who don't know, 25 basis points is 0.25%. Doesn't sound like a lot, but there's going to be likely going to be several cuts over the course of the next year. So this is just the start, feeling out the market, making sure there aren't any major movements in one direction or another after they cut the rates. There's a smaller chance, about 5 to 10%, that the cut could be bigger, 50 basis points. Not likely, but it is a possibility. Like I said, the Feds are going to want to watch and see what happens whenever they do this basis point drop, so 25 basis point drop. So like I said, not likely that it's going to be 50, but who knows? We'll find out tomorrow. All right, so what caused the rate cut? The labor market has been weakening. Recent job growth has softened. They didn't see the job growth that they were hoping for, and so they're hoping that lowering the interest rates will help out businesses. Businesses, having cheaper loans will make it so that they have more money to be able to hire more personnel, more employees, and then things will just start snowballing from there. Another thing is inflation isn't going away like we had hoped, but some of its measures have moderated. So it's kind of evened out, but like I said, it hasn't dropped like we had hoped. And so we're hoping that this rate cut can help stimulate the economy a little bit and hopefully mitigate some of the inflation. It's kind of a gamble in that regard because oftentimes doing rate cuts can actually cause more inflation. So we'll see what happens. All right, what happens when the Fed cuts rates? It makes cheaper costs, easier to borrow for expansion mortgages and car loans. More people are going to start buying houses again. People are going to start buying cars again. They're going to start investing more. And so it starts to stimulate the economy. Things start doing better. And like I said, gross domestic product goes up. The country just starts doing better. And so that's why inflation could potentially start going down as a result of all of this. For companies, lower borrowing costs can boost profits and encourage growth, which tends to be good for stocks. Like I mentioned before, companies having less expenses is good for their balance sheet. Makes it so they can hire more people, they can create more products, they can do more things, and it inspires companies, and then it inspires investors to invest in those companies. Growth stocks usually benefit the most from this, just because the growth of companies, they want to see that. Dividend stocks, they don't do quite as well during this time, and so that's something to be careful of whenever you're choosing your investment portfolio. Overall, market sentiment improves. Like I said, people just end up having more money in their pockets because they've refinanced their houses, they've gotten cheaper loans, and so maybe they're doing consolidation loans for their credit cards, and so it makes overall market sentiment much more positive and improved, and everyone's happier. All right, so what should I do? Well, in the short term, things can get a little volatile. In the first month, we're looking at some rocky patches. Sometimes it goes up, sometimes it goes down. In fact, about 50-50 chance that things go down or up. What's cool about that is these could present really good buying opportunities for you. And so I would encourage you to have some cash on hand so that if something does do a sharp swing downward, that you buy in. Like I said, this could be a really good buying opportunity. And then over the course of the next year, expect substantial growth over the next year. And I'm going to show you a post on Twitter, or X, sorry. Rate cuts at record highs. In 20 out of the 20 times that the Fed has cut rates with the S&P 500 at record highs, stocks ended higher 12 months later. In fact, the S&P 500 rallied an average of 13.9% over the next 12 months, according to Carson Research. However, in 11 out of the last 22 times that this happened, stocks ended lower 1 month later. Near-term volatility will lead to long-term buying opportunities. So like I said, over the course of the next month, things could be a little bit rocky. In fact, it says there's a 50-50 chance that things will be, rocky, or maybe the markets will go red. And in fact, oftentimes September can be a little rocky path anyway. And so actually having this Fed rate cut could make that even more rocky. And so, like I said, now is a good time to have some money on the sideline ready and poised and ready to buy something that comes out as a good deal. It could just be the S&P 500 like VU or SPY. It could be something more aggressive like MicroStrategy. And so be watching for those good deals. I'll try and post a video if I see something that's like, oh my gosh, we should get in on this. Anyway, that's what we're looking at for the next day. I'm excited to see what's going to happen over the course of the next year. I think it's going to be a good time for us all to make some extra money. Anyway, thanks for joining me today. If you've liked the video, feel free to like and subscribe, comment down below. I'll see you for the next one. Thanks.